So let's have a look at what is relevant for small businesses. The needs for cash flows and needs are going to be driven by the long term and the short term. In the long run, as I said, if you've got a profitable business, then you should be able to survive and you should generate cash and be able to make a nice living for the person who started it and for the owners of the business. In the short term though, and this is particularly true for startups, your cash flows aren't going to be driven so much by the profitability, but more by the noise of your receivables and payables and other payments you've got to make, particularly money going out in the earlier stages. So we're going to talk through that with a common example. So let's say you're a new business and you are wanting to start out and you want to go to your bank manager. You've got the two steps. First of all, you work out whether or not this is a business that has a chance of profitability. That makes sense. Obviously, as we said, in the long run, you need to be profitable to generate money. It's often the case, of course, that a startup loses money in the beginning simply because your costs, and many of them are there at the beginning, but the revenue builds up over time. So you have to anticipate that you may lose money at the beginning, but it could well be something that's going to generate a nice healthy profit as you go forward. The other thing you have to do though, and this is the thing that kills many businesses, you have to translate that profitability into what that's going to do for your cash flows. Let's go through and look at a couple of examples, or a simple example as to how you can do this. Let's say a basic example. Let's say that you are a manufacturer and you make and sell widgets. Widgets, of course, as we all know, are simple little manufactured boxes which have several component parts. They need a little bit of assembly and then you can sell them. And let's say that you can sell each one for $10, but the component parts of that cost $5. Now, you've rented a small shop to do this. You've got fixed costs of running your place of about $2,500 a month. That's mainly rent, but you've got things like insurance, and you may have somebody who's on staff as well, who you're paying a fixed salary every month, the same amount to do so. So let's say that those fixed costs are $2,500 a month, and in the first month, you make 100 widgets and you're able to sell all of them. In the second month, you make 200 widgets and you can sell all of them. In the third month, 300 widgets, and so forth. Okay, should be a fairly straightforward one. Let's work out the numbers, and I've got two questions to ask you. The first question is, in which month do you think you first break even? As in which month do you think you're not going to be losing money? The second question is, at what point do you think you've made back all your startup losses? Because if you're going through what I call the starving time at the beginning and money is flowing out, obviously your first few months of profitability are going to go towards filling in those losses and digging yourself back out of the hole. Well, I can give you more detailed numbers as to what it looks like. It looks like this, but if you want to see it on a graph, this is what you should look at. So let's have a look at this. Your blue line is your sales. It starts at 100 units or $1,000 in month one because you're selling 100 widgets at $10 each. The red line is your variable costs. Each widget you've made and sold costs you $5. The gap between those two, your sales price and your cost of production, is known as your margin. And it's going to be constant at $5 a widget, so as you go forward and your sales increase, your gross margin in absolute dollar terms is going to increase as well. So your gross margin on this picture here is the gap between the blue line and the red line. On the other hand, you've also got to factor in your operating costs, your running the business costs, those that don't change regardless of your volume of activity. Now, in many businesses, as you grow, they tend to go up in steps as you hire another person or take on more space. But we've assumed that in your startup here, you've got everything you need. So let's look at it this way. From month one, from the day you open your doors, you've got $2,500 going out of the door to pay your rent, your insurance, and so forth. Now, in your first month, you're going to lose money, clearly, because you've sold $1,000 worth of widgets, which cost you $500 to make. And you therefore got a surplus from those of $500, but on the other hand, you've had $2,500 go out of the door for your rent and so forth. In February, it gets a bit better. Your margin is $2,000 of sales less $1,000 of cost, so that's $1,000, but you've still got $2,500 going out the door for rent and so forth. So as you can see, it gets somewhat better. The month at which you break even is May. Now, it's just coincidence that on this graph, that's where the red line and the orange line intersect and cross each other. That's an unfortunate coincidence of it. What's relevant, though, is that the gap between the blue line and the red line being the margin or the amount you make on actually assembling and selling these widgets, that's the point at which that gap is equal to the height of the orange line. So that's the point at which you break even. So you need to be aware that in the first 4 months, you're going to be making losses. Month 5 is going to be a break-even month. And then from then on, you should be turning profit because your margin, what you're making and selling on each unit, is more in total than what you're paying to keep the doors open. Now, for many businesses, this varies and it's somewhat simpler. In many businesses, for example, if you don't actually have a direct cost of making something, you don't have the component parts for your widgets, then the red line is irrelevant, and essentially you're just looking at that intersection of the blue line, meaning your sales revenues, with your orange line, which is your cost of keeping the door open. But the basic principle still stays the same. You've got to understand that you'll start from a low level, and as you grow, you will get to the point where you break even. So as I said, May is the break-even point, but it's worth looking at this one as well, because this is your cumulative position. Don't forget, January, February, March, and April, you've been digging yourself into a hole. Well, that's a harsh way of putting it, but you've been burning through the cash reserve that you carefully set aside, and it's only in May that you start to break even and then turn a profit. But your cumulative deficit doesn't get wiped out until sometime between August and September. After that, though, you're doing quite nicely because your profit is growing every month as your sales are increasing every month and your margins increasing every month, but on the other hand, your fixed costs remain constant. Now, obviously, this is a very simplified example and it's been done in some fairly basic numbers that change dramatically, just to give you the idea of it. In the real world, obviously, if you're starting a business, then often it does take longer than this. And frankly, as well, it's impossible to project. You have no idea what it's going to be. It will never be as smooth as this, but at least, hopefully, you can come up with some projections and some ideas of it. Now, that is profitability. Many businesses can get their head around that idea, and they can say, how profitable are we going to be? When are we going to turn a profit? What kills many companies, though many potentially brilliant companies, is that they've misunderstood what that's going to do to their cash. So let's have a look at the cash situation, because this is profit, not cash. Let's make some assumptions. Let's say that you're selling your widgets to your customers on credit, and your customers are taking 60 days to pay or 2 months to pay. Your suppliers will give you 30 days. On the other hand, your fixed costs, being your rent and your insurance and your staff, they like to be paid in the month in which they're due. Plus also, you've got some startup costs. When you open the doors, you've got to pay some deposits in the first month. In January, you'll get them back next year. And also, you've got to spend money on buying equipment. You're going to spend $5,000 in January, $5,000 in July. What's the cash going to look like? And be warned, this looks scary. We've already seen the blue line. Your cash is the red line. Now, at this point, I've had grown men in this presentation burst into tears and run screaming from the room, so don't panic, okay? Let's see if we can work this out. Why does that happen? Well, in month 1, you've had your operating spend have gone out of the door, so you know that you've made a loss. On the other hand, you've also put down your deposits, and you've also spent money on the capital equipment. Okay, fair enough, that we know. In month 2, you look at it and say, right, I haven't got any more one-time start-off costs, but I've now got to pay my suppliers from month 1, as well as before paying my office rent, my staff, and so forth. Have I had any money in? No, not yet, because your customers will pay you on 60 days. Let's go forward into March. You're still paying your rent and your staff and your insurance. You've now paid 3 months' worth of those costs. You've also now paid your January and February suppliers. And congratulations, you've got your first money in the bank. It's from your first $1,000 worth of sales that you made back in January. So although you're turning the corner in terms of profitability, you're showing more profit every month or a smaller loss every month, and from May, your finances, your money, it looks as if it's getting worse and worse. And just as you think you turn the corner in May and you think that things have improved because you're no longer making a loss, you open your May bank statement and to your vast horror, it shows you've got an overdraft of about $30,000. And in June, you say, this is good, I made a profit. But the cash has got worse. It's got worse because of the timing of your cash flows. Although your trading is profitable, the money going out for that happens before the money comes in from it. So this is what kills a lot of companies. They don't anticipate that even though they may have turned the corner in profitability as early as May, in this case, you may well be still having money go out of the door for as long as until August or September, simply because of that lag in the payments. And also because you paid for your equipment and also you're paying all your other upfront costs at the beginning, although the worst case you may have in loss is to make a cumulative loss of say $5,000, It gets worse than that for the cash. Your cash, in fact, can go as low as $30,000 in this example because of the suppliers you have to pay in advance. So you can imagine how this kills businesses. You would go to the bank with your projections saying, I feel that in my worst case, I'm going to lose $5,000. So I'll be conservative. I'd like to ask to borrow 15. And your bank manager says, sure, we'll lend you 15. Well, you burn through that by the end of February. March gets worse. So you go back and you ask for another loan, say, oh, we'll give you another 10. So you get up to 25. But it's now in June. Things are still getting worse. You go back to your bank manager again and they may not be so understanding the second time round. So you get the idea. But the key thing is, this is a bankable business. Let's have a look at this in a little bit more detail. If you look at what this business has and what it owes, at the end of December, cumulatively, you are in profit. You've made a surplus, you've made it back. But what's that represented by? You've got receivables of $23,000. That is the money that your customers owe you for your last 2 months worth of sales. In this case, November and December, $11,000 and $12,000. You've got those deposits that you paid out, you're going to get those back, and you've also got your capital equipment, which is an asset of the business that has value. How's that been funded though? Well, you owe your suppliers for December's purchases, which is $6,000. Fair enough. But if we look at this, we've got assets of 41 offset by payables of 6. That's 35 of net assets before we take that into account. But we've got 35 of net assets that are only being supported by $9,000 of profit. In other words, that other $26,000 has to come somewhere, and that's where your line of credit looks. So the question is, would you lend money to this business? Well, it looks scary, but for the most part, this is what you might describe as a bankable business. If you were to collapse all or collect all of your receivables and everything that's owed to you and to pay off all of your bills, you're going to look at what your working capital says, and if it's positive, you're in good shape. So as a general rule, although there's uncertainty, you can, as long as you capitalize adequately, you can make sure that you're going to be able to get the cash that you need to reduce your chances of becoming one of those statistics.